Hi everybody, and welcome back to video number 3 in chapter 19. And when we left off, we were looking at the Zarl Company as an illustration. So on January 1, 2025, Zarl Company provides the following information related to its pension plan for the year 2025. 1. Plan assets. At the beginning of the year, $100,000. Projected benefit obligation, beginning of the year, $100,000. Annual service cost, $9,000. Settlement rate, 10%. Annual return on planned assets is $10,000. Funding contributions are $8,000. And finally, benefits paid to retirees during the year are $7,000. What is the pension worksheet that you would prepare for Zarl? Well, here it is. And as shown earlier, the same format for general journal entries and memo records. So here we're going to record the service cost, the interest cost, and the annual return as credits, contributions for cash, credit, and pension asset liability of $1,000, the difference between the debit entries here and the credit entries here, $1,000. For projected benefit obligation, we start with a credit of $100,000, add the $9,000 and the $10,000, and debit $7,000 for benefits paid. And that gives me $112,000. The plan assets, we have a debit entry for $100,000 for beginning balance, and then we have a debit entry for actual return of $10,000, contributions of $8,000 debit, and finally a credit of $7,000 for benefits. Total $111,000 debit balance. Okay, so now for an explanation, entry alpha on the previous page, here, service cost, records the service cost component, which increases pension expense by $9,000 and increases the liability, the projected benefit obligation, by $9,000. Entry Bravo, which is interest cost here, that accrues the interest expense component, which increases pension expense by $10,000. That's the beginning projected benefit obligation multiplied by the settlement rate of 10%. And it increases the liability by $10,000. If I look back on entry Charlie, our actual return, it records the actual return on planned assets, which increases planned assets and decreases the pension expense here. And then under entry Delta, contributions, that records Zarl's contribution funding of assets to the pension fund, thereby decreasing cash by $8,000 and increasing plan assets by $8,000. And then finally, entry Echo, benefits. The entry Echo records the benefit payments made to retirees, which results in equal $7,000 decrease to the plan assets and the projected benefit obligation. So if we continue on with this example, Zarl is going to make the following journal entry at the end of the year and records pension expense as follows. Pension expense is going to be $9,000, and that's comprised of a credit to cash of $8,000 and a credit to pension asset liability of $1,000. And you can see that $1,000 here and that $9,000 here, and that $8,000 here. Here, I should say, cash. Okay. Now, in the previous example, the credit to pension asset liability for $1,000 represents the difference between the 2025 pension expense of $9,000 and the amount funded of $8,000. And here is shown the $112,000 projected benefit obligation, which is a credit, and the plan assets at fair value, which is a debit, and finally the pension asset liability, which is a credit balance underfunded of $1,000. All right, now the following data apply to a new company, Brick House Incorporated, for the year 2025. So they give you plan assets at the beginning of the year, projected benefit obligation at the beginning of the year, service cost, contributions, actual return on plan assets, benefits paid to retirees, and a settlement rate of 6%. They want you to use the above data to compute the pension expense for the year 2025. And as part of your solution, prepare the pension worksheet that shows the journal entry for pension expense for 2025 and the year-end balances in the related pension accounts. So here is the annual pension expense. We have service cost, interest cost, and the actual return. And the journal entry at December 31, 2025 would be $25,700 debit. Cash would be the $40,000 contribution, which would be a credit. And so the pension asset liability then would be $14,300 debit. All right. And then if we look in the memos, we have the projected benefit obligation here of $405,000 and the plan assets here of $419,300. So this is good news in a way. We have $25,700 here for pension expense. We have the $14,300 pension asset / liability, and finally our cash credit of $40,000. Okay, so now we'll change gears a little bit and look at describing the accounting and amortization of prior service costs. So, prior service cost, abbreviated PSC, the amortization. The company should not recognize retroactive benefits as a pension expense in the year of amendment. The employer should recognize pension expense over the remaining service lives of the employees who are expected to benefit from the change in the plan. So, the amortization method. The board prefers a years of service method. Employers may use straight line amortization over the average remaining service life of the employees. Let's take a look at an illustration. Back to Zarro Company, and its defined benefit pension plan covers 170 employees. In its negotiations with the employees, Zarro Company amends its pension plan on January 1, 2026 and grants $80,000 of prior service costs to its employees. The employees are grouped according to expected years of retirement as shown in this schedule. Group Alpha, Bravo, Charlie, Delta, and Echo. And there's the 170 employees and their expected retirement dates here. The question then, Alpha, what are the service years per year, and in total, Bravo, what is the annual amortization for those years from 2026 to 2030? Well, if we multiply this all through here, we're going to take a look at Alpha, Bravo, Charlie, Delta, and Echo for a total of 170, and then it decreases by the 40 retirees in Alpha, and etc. all the way down. And that totals 500 service years. So, in Bravo, given a prior service cost of $80,000 and a total of 500 service years for all years, the cost per service year is $160. That's $80,000 divided by 500 total service years. The annual amount of the amortization based on $160 cost per service year is as follows. So here's our total service years from the schedule here, and the cost per service year, and how it breaks out into annual amortization. $80,000. Now, I've got $80,000, and here my expense is $27,211. And we get that expense, and for 2027, $27,211. And then for 2028, we take 94% of $27,211 to get $80,000 expense here. Okay. Now, continuing with this example, the Zarro company's pension plan into 2026, we assume the company amends the pension plan on January 1, 2026 to grant employees prior service benefits with a present value of $80,000. Zarro uses the annual amortization amounts computed in the example before using the years of service approach. That was the $27,200 for 2026. You'll remember from here. And then some additional facts: the annual service cost of $9,500, settlement rate of 10%, annual return on plan assets is $11,100, annual funding contributions $20,000, benefits paid to retirees during the year are $8,000, amortization of prior service cost using the years of service method $27,200, and then accumulated other comprehensive income, hereafter referred to as accumulated OCI, on December 31, 2025 is 0. So what is the pension worksheet that you would prepare for Zarro in 2026? And here it is. Here's our service cost, the interest cost, the annual return, the amortization of the prior service cost, contributions, and prior service cost here. And finally, our pension asset liability, $78,600, and our projected benefit obligation and planned assets. Okay, that looks like a good place to stop this video. And when we return, we will take a look at the journal entries for Zarro. Until that time, bye for now.